Hello dear viewers, hope you all are doing well. Welcome to our yet another video on Introduction to Accounting Class 11. Today in this video, we will be focusing on basic terms of accounting. Basic terms of accounting, this concept is very important with the point of view that as we move ahead and as we study our chapters ahead, it is very important for us to understand the meaning of certain accounting terms so that our study further becomes easy. So let us learn about the meaning of various terms used in accountancy. Let us start with an example here.
Okay, let us assume that there's this person. Let us name her as Vidya. Now, she wanted to start a business and she thought of starting a clothing business. Okay, she thought of starting a clothing business. Now, for any kind of business, just a plan is not enough. We need some amount of money, some machineries related to that business. Here, she's starting a clothing business. Let us assume she had some savings, and out of that saving, she is thinking to invest that amount into her business. Now, let us see that she had rupees 1 lakh. Okay, out of which she put this as cash. Okay, and she bought a new sewing machine, clothing business. She bought a new sewing machine of rupees some 15,000. This 1,15,000 she invested towards her business. Okay, a worth rupees 1,15,000. She bought in cash 1,15,000 as a machinery. Total worth of rupees 1,15,000 she is investing or contributing towards the her new business. This is known as capital. Since she is starting the business, she will be termed as owner, right? As a owner, whatever you are investing or contributing, a cash or any kind towards the business is termed as capital. And owner, in terms of accounting, is referred to as proprietor. Owner is known as proprietor, and whatever amount proprietor is investing towards the business is known as capital. Now let us assume that since it's a clothing business, she has to deal with various products like some fabrics or various types of clothing stuff, raw materials, ready-made clothes, whatever it may be. Okay, all these products which are related to business, which the business is dealing in, products like selling or buying, all those products are known as goods of that business. Since here she is starting a clothing business, whatever products which are related to clothing business are goods of that business. Here we studied about proprietor. Owner is known as proprietor, and what is capital and what are goods. Now let us look into our slides and understand about meanings.
We had just looked into one example and we studied about few of the terms. Let us go through the slide now. Basic terms of accounting. Here our first word is entity. Business entity means a specifically identifiable business enterprise. Yes, like an organization and company is known as this entity. It has its own individual existence, business enterprise. Like we can say some ABC Jewelers, some XYZ stationery shop. All this is a business enterprise and is termed as an entity in accounting terminology. Next is transaction, event involving a value between two or more entities. It can be a cash or credit transaction. Here, assume that you have rupees 500 now, and you purchased clothes of rupees 400. Let us assume you purchased clothes of rupees 400. This transaction between the owner and the consumer, between you, it can be termed as an transaction. This event can be termed as a transaction event involving some value between. There's a value of rupees 400. There's a exchange of monetary terms, monetary value, ownership of the product is known as a transaction. Account, a record of debit and credit entries to cover transactions involving particular item. Yes, account is nothing but recording of transaction. It is done in a particular format, like debit and credit in a particular format where we write debit and credit, debit on the left side and credit on the right side. This we will be learning more as we study about the next chapters, in the next chapters. Next we have proprietor. Yes, we just had look who is a proprietor, a person who owns the business and contributes the capital to earn the profit. Yes, we just saw an example about Vidya where she was thinking to start a business and she started her new business, clothing business, and since she started it, she was termed as an owner, and owner is termed as a proprietor. Next, capital, amount invested by the owner. We saw that Vidya invested worth rupees 1,15,000 into her clothing business. Next, goods. It refers to the products in which the business unit is dealing, terms which are buying and selling or producing or selling. Here we saw that goods of that clothing business, like fabrics, all the ready-made clothes, clothing stuff, various types, whatever a business is dealing into, or purchasing, buying, selling, producing, all those types of products are known as goods of that entity. Next, we have asset, and valuable thing that has monetary value, which is owned by the business. Now, let us again go back to the example and understand about this.
Now, let us study about assets. Okay, assets are those economic resources which an enterprise owns, which helps to generate income. So, they are valuable resources owned by the businesses, which helps them to generate income, which are of valuable resources. Again, assets are of two types. Let us first study about current assets. Okay, assets are of two types. One is again in that current asset. Current assets are the assets which are used for short term purpose, and then they are converted into cash within 1 year, for less than 1 year, which get converted into the cash generally for 1 year. Okay, those are termed as current assets. Like various types of current assets are our stock, cash with the business. Okay, now one more, another type of asset is fixed assets. Here, fixed assets means assets which are owned by the business for a very long period of time. Long period of time, which gives benefit, for benefit of those assets can be taken for a long period of time compared to the current assets. Here we can see in our example, as we saw, she had a sieving machine, right? This sieving machine we don't use only for 1 year, we can use it for some 10-15 years, if and we can repair it as and when it is required, and we can use it for long term, right? These items which are used for the long term are known as fixed assets. Here we can again assume that she buys a building is a long term asset. She buys purchases computer for computerized billing and all. The computer is used for long term purpose and gives benefits for a considerably long period, more than a year. Those items which are useful into business, which add value to the business for more than a year and can be used for the long period of time, are known as fixed assets. Like our various examples of fixed assets are what sieving machine she had, land and building, furnitures, right? In case if she had purchased computers, some plant and machineries, various machineries if she had again purchased, all this becomes the fixed assets which are used in the normal operations of the business. Such are known as fixed assets, and which benefit is existence only for an year and then they are converted into cash are known as current assets. So similarly, we with assets we have another term known as liabilities. It is important for us to understand what liabilities do. Okay. So liabilities in simple meaning, let us understand it as responsibilities of business. Responsibilities of business. So liabilities are those obligations that an enterprise has to pay in some time in future, is responsible to pay off. Okay. So again, liabilities are of two types. That is current liabilities and non-current liabilities. First, let us understand about current liabilities. Okay, so current liabilities are those responsibilities or those liabilities which can be settled within a year. Here again, current is less than 1 year, which can be settled within 1 year. These are short-term obligations. Short-term obligations, responsibilities that are due within 1 year and can be repaid within a normal operating cycle, like our expenses, like salaries which we pay to our employees, wages. These are all short-term liabilities, our short-term responsibilities. Another one we have, that is non-current liabilities, right? Now, again, non-current liabilities are those liabilities which cannot be settled within 1 year, which exist for more than an year. So, in other words, they are due. They that cannot be settled within 1 year. So, like let us assume in our business we have taken a loan. and we have taken loan of some rupees 5 lakh. It is not possible to pay off 5 lakh in 1 year, right? So such loans, long term loans which are taken by banks, uh, cannot be settled in a 1 year, and those are termed as long term liabilities. An example is loans, long term loans, debentures. We have something known as debentures. All these are examples which cannot be settled within an year, right? So here we studied about two main concepts. Let us revise once more. First one, we studied about assets. So two types of assets: current asset and fixed assets. Again, in current assets, we saw that which are less than an year can be converted into cash, and which benefit is for an year. And fixed assets are those resources, valuable resources, which are used for a long period of time and whose benefit is extended and can be used for very long period of time, like land and machineries, buildings, furnitures, fixtures, machineries, whatever owned by the business, which are used for a long period of time, are known as fixed assets. And current assets are those which are used for a short term period, like an year, and then they are converted into cash. Next, we studied about liabilities. Liabilities in simple term are the responsibilities of the business which they have to settle. And again, there are two types: it is current liabilities and non-current liabilities. Current liabilities are again which have to be settled within an year, in a short term period, like our creditors. Who are our creditors and what does it exactly mean, we will be studying in our video in next slide. Next, we have non-current, which again means that they cannot be settled in a very short period of time, like 1 year. They are settled, which these liabilities, these responsibilities exist for more than 1 year, like loan. Example is our loan. Now let us read our slide. Let us go through the slides and understand the meaning. First, we have assets. Here, assets are the valuable thing that has monetary value, yes, which is owned by the business. We saw that assets are the valuable resources which are owned by the business, which helps in generating income to the business. We saw that assets are again of two types: current assets and fixed assets. Current assets which are used up to 1 year, and they are again converted into cash. The time span of the current assets is up to 1 year, and then they are converted into cash, like we have our debtors, stock, example, cash. Next, we have fixed assets. Fixed assets are whose benefit, the value of the benefit of these kind of assets is for a long period of time. Such assets is known as fixed assets. Here we can take examples of land, building, machineries, whatever. We just don't buy with the motive to sell them for an next just within a year. We buy them with the motive to keep them with us for a very long period of time and use them for the business. Such assets are known as fixed assets. Here we studied that assets are of two types: current assets and fixed assets. These are very important concepts. You should understand the meanings. Next, we have liabilities. Liabilities we study are in simple term. Liability is nothing but a responsibility of a business which they have to pay in some time, which they have to settle all their dues in some time. There are again two types of liabilities: long term and short term, which are also known as current, non-current liabilities. First, long term liabilities, also known as non-current liabilities, which are payable after a period of 1 year. There is no these liabilities are not settled within 1 year, but are taken time more than 1 year, like an example of bank loan. Financial institutions, loans from financial institutions. Next, short term period, these loans which are payable within 1 year. Current short term liabilities are again current liabilities which are payable within 1 year, like our creditors and bank overdrafts. Next, purchases are the total amount of goods procured by a business on credit or for use or for sale. Yes. Now let us assume that we have taken an example of Vidya. Now, since she wanted to start a business, she had to purchase something, like she had to purchase some various types of cloth, fabrics, textiles, ready-made clothes to start some business. Whatever the purchase business is buying are termed as purchases. They are recorded as purchases of the business, right? Next, we have sales. Sales are the total revenue from goods and services sold to customers. Sales may be in cash or credit sales. Here again, sales is nothing but since she now she has variety of clothes and various customers are coming, and she is selling all of those. Now sales are what is going out from the business. She is making sales. that those are recorded as sales of the business, and whatever is coming into the business is recorded as purchases. Next, we have purchase return. Goods once purchased by the business are returned back due to any reason is called as a purchase return. Now I have they had bought some cloth, like some fabric, but there some clothes were of damaged pieces. Now she is returning back to the manufacturer. She gives back to the dealer. In such cases, this is known as purchase return. Now another, we have sales return. Now I had purchased something from Vidya's shop. Now there are some now I feel that the size is not correct for me, or the color is not matching with what outfit I had bought, the clothing business. Since now I'll go back and return her the item. Whatever had gone out is again coming into the business is known as sales return. Whatever purchases she had made and she is returning back to the manufacturer or the wholesaler is known as purchase return. Stock on hand is the amount of goods which are lying unsold as the end of the accounting period. So stock is nothing but whatever item, whatever products and business is holding which are unsold for a particular accounting period is known as a stock. Revenue. Revenue is the amount of business earned by selling. Now Vidya has variety of fabrics, ready-made clothes, jeans, pants. According to various trends, she has all types of stuff in her clothing business. Whatever money she is earning by selling all those clothing stuff can be termed as revenue. Providing service by selling and providing service is called sales revenue. Next, we have expenses. Cost incurred by a business to process of earning are known as expenses. So expenses is something which is related to our selling activities. Maybe she had taken up various advertising activities. She had given various pamphlets to make her business popular. She had undertaken various distribution channels. She was giving door to door delivery, because of which she incurred some shipping charges. All this expenses or charges which she is incurring in connection to selling her products are known as expenses. Next, we have expenditure. Expenses is how expenses is different from expenditure. We have to understand here. Spending money in incurring a liability for or some benefit or service for property is known as expenditure. Expenditure are the amount of money which we spend while taking up any like land or building assets which we are taking for a long period of time, and the expenses incurred while for such things are known as expenditure. Next, we have income. The profit. Income is nothing but the profit earned by the accounting period, which is calculated as revenue minus expense. We learned that revenue is the money earned because of selling, and expenses are the the charges incurred for the selling. Whatever revenue we had got, when we minus expenses, all our expenses from that, whatever amount is remaining, that can be termed as profit. So it is nothing but excess of revenue over expenses is termed as income. We have a formula is known as income is equal to revenue minus expenses. Loss. Excess of expenses of a period over its related revenue. In case we had undertaken a lot of advertising, but still our products did not made a sale. There was no sale and we incurred loss. We did a huge amount of advertising campaigns, but there was no good result, and we spent a lot more on advertising than we had revenue. In that case, we incur loss. That is known as loss, where expense is more than revenue can be termed as loss, and when revenue is more than expense can be termed as income. Term is gain. Gain is increase in total value of the asset of a business. It takes place when the current price of asset exceeds the original price. Here I'll tell you with an example what is gain. So now since I was doing a business and I bought a land, okay, need not to be what I bought land for price today. The price will not be same for another 1 year, right? There will be some appreciation, there will be some increase there. The price of that, the value of that land will be increased. So then in that case I'll make a gain there. So there will be appreciation in the value of that land. So it means that current price of the asset exceeds its original purchase price, then it is termed as a gain. Next, we have profit. Excess of revenue over expenses. We saw that income is nothing but profit, which is excess of where our revenue is more than whatever expenses we incurred for an accounting period. So profit is nothing but always a positive difference in selling of goods and services. Whatever sales we made, in that we are minus, we take off all the expenses we had undertaken, and whatever amount is left behind is nothing but the profit made by the business. due to its business activities. Next is cost. So expenses which incurred for the production of goods and services. Now we saw it was a clothing business, right? For the clothing business, she takes up like packaging cost, stitching cost, whatever cost she is incurring due to production of goods and services is known as cost to that business. Now debtor and creditor, let us again go back to our example and understand. Now let us understand about creditors and debtors. Who are creditors and debtors? First, creditor is somebody who from whom we have purchased goods on credit. Like let us take an example of Vidya here again, her clothing business. So her clothing business has taken goods on credit. Okay. Here let us assume that now Vidya doing good sales in the market, and she is continuously purchasing fabrics from various manufacturers or wholesalers. In that case, she is purchasing from various people. In that case, she promises her manufacturers that she will pay in 3 months or some 6 months in the future date. In such cases, she is purchasing goods on credit. She is doing credit purchase. She is promising that she will pay off the money, she will settle all the money in the later date. In such cases, they are known as creditors because they are giving the business, we are purchasing goods and service on credit. They are known as creditors. There's another concept known as debtors. I'll tell you what is this. Debtors. Debtors. Now, let us take again example of Vidya itself. She is doing good in the market. Now what she has done, since she is purchasing all the fabrics in bulk, now she has all the resources, she has good sewing machine. Now she started to stitch clothes, she started to make her own design. She had a good fashion designing sense. She is doing good in the market, and various small businesses were buying various ready-made clothes in bulk from her, right? They were buying in bulk from her, and these people were promising her that we will pay you money in later date. It's not possible for every business to pay all the entire amount in the same month. In such cases, they make a credit purchase. Here, since she is selling to various businesses, right? She is doing credit sales, she is giving on credit. In such cases, these people become the debtors to the business, whom we have the goods and services are sold on credit are known as debtors, and from whom the goods and services are purchased on credit are known as creditors. So this is the major difference between creditors and debtors, and it's very important for us to understand who is creditor and who is a debtor. Debtor is somebody who has sold. So here in such case, Vidya becomes the debtor because she is selling in bulk to various small business entities in her area, and they have promised her that they will pay her in some 3 months, 6 months later date. She has made sales them in credit sales. Credit sales is nothing but sale is made, but the value of that amount is paid in the later date. And cash sales is nothing but as and when the cash is received is cash sales. And next, one more concept is creditors. In creditors point of view, Vidya is purchasing from different manufacturers, and she is again purchasing on credit. That becomes credit purchase. And if she is purchasing it for cash, as and when she is settling the transaction with the cash, then it becomes the cash purchase, and they become the creditors. We have to pay our due to them. We are liable to pay. We have the responsibility to settle our due with them. Then they are known as creditors. They are in our liabilities section. Assets, debtors are somebody from whom we have to receive our money, and they are in our asset column. So this is about assets, debtors and creditors. Let us read our slides now. So let us read here what is a debtor. Debtor is an individual or entity that owes money to the business. Companies treat it as an asset because they will get money from them in the near future. So we learned that debtor is somebody whom the business has given goods on credit, has made credit sales here, and they are treated as asset in the sense because we will get money from them in the future. Next is creditor. Creditor is an individual or entity from whom business owes money to, where business is liable to pay money to the creditors. Business is liable to pay money to the other business parties. So companies treat this as liability. Our responsibility to pay our dues, will pay them in the near or distant future. So this is about debtor and creditor. Next, discount. Yes, the word discount we are very much familiar. We use it like 50% discount sale, 25% festive season sale, right? But what exactly is this discount? Here, discount is reduction of either the monetary value or the percentage of normal selling price of product or service. Yes, right. Whenever we visit any shop, we tell the shopkeeper, please give some discount. What is this discount actually? This discount is nothing but reduction in the price of the products. Like in case if there is some 25% discount for your 1000 rupees jeans pants, then 25%, that is 1000 ka 25% is 250 rupees. 250 rupees is deducted from 1000 rupees. That is your discount. That is, there is a reduction, there is some value is deducted from the total price, selling price of the product or service. Next is financial year. Financial year is the period between 1st April to 31st March. This is our business calendar, which is followed by all the business entities, that they keep their accounts ready for the calendar year, for the business calendar financial year, that is 1st April to 31st March, accounting year in which every business earns income. Next is voucher. Voucher is nothing but a document, we can say. Document in the sense, if you go to any mall and purchase anything, they give you a bill, a computerized bill of all the particulars you have purchased, the price, the quantity. This is nothing but this is a voucher. Voucher is a written document to support the particular transaction. It includes cash memo given by the seller for purchase, and other credit purchase. So it is nothing but in simple terms we can say it is a bill. It is a document, proof of purchase. Next is balance sheet. Balance sheet is a statement of financial position of business at a particular date, which shows the asset, liability, capital, reserve, and all account balances. So balance sheet is nothing but a financial statement, or statement which is prepared by the business entity, which represents everything represents everything like assets, liabilities, our capital, reserves, and what are our various account balances at their book value is all presented in our balance sheet. Next is turnover. The total amount of cash and credit sales during a period is known as turnover. All the total sum of cash and credit sales made by the business entity for a particular period is termed as turnover. So these are few of the basic terms of accounting, which is very important for us to understand the meaning of each and every term, because as we move forward in the next chapters, it will be helpful for us to understand the concepts more easily. If you have any doubt in regarding any of the concept, please put out into comments and we will solve them at earliest. Until then, signing off. Happy learning.